We just wrapped up shooting the presidential election in your retirement, and we focused a lot on market volatility. So here's what we know. Markets are typically more volatile than average in the lead up to an election. Well, we're in an election year, so what does it mean for your retirement? I think in order to understand how it could impact your retirement, it's good to look at some historical data. So I've pulled some today for you. Stock market returns tend to be weaker than average in election years. Since 1932, the S&P 500 has averaged a 7% return in the 12 months preceding the election, compared with a 9% return in years outside of election years or in non-election years. Pre-election returns have been even weaker in recent history, with the S&P 500 posting an average return of just 4% in the 12 months ahead of the 10 presidential elections since 1984. So factors that impact the stock market. We're talking about the election itself. Well, part of what the candidates will be talking about and also part of what can affect the stock market is the economy. So what economic factors are we looking at in this presidential year? Presidential election year, we're looking at interest rates. What will the Feds do with interest rates and how will that impact the stock market? Student loan payments, definitely something people are talking about. You know, those started up again in late 2023 after 3 years of relief, and that impacts some 22 million people in our country. That's 22 million people. Credit card debt. A lot of news outlets reporting that credit card debt in the United States is at a record high of $1.13 trillion. So we're talking about these factors that can impact the economy and impact the stock market. Sometimes elections and other factors coincide in the same year and they create all kinds of stock market volatility. Let's look at some factors in recent memory. 2000, the dot-com bubble burst began. That lasted for a while, bottomed out in October of 2002 when the NASDAQ had lost nearly 80% of its value. 2008, you'll recall the collapse of the housing market. There were 4 days from the end of September to early December when the S&P 500 lost 7% and 8% of its value in a single day. The market eventually bottomed in March of 2009 with the S&P 500 losing nearly 60% from its October of 2007 peak. It took almost 6 years until April of 2013 until the S&P recovered and finally surpassed its previous high. And then there's 2020. Remember March of 2020? Of course you do. COVID-19. The Dow fell almost 3,000 points or nearly 13%, its largest decline ever. The S&P fell 30% over the course of 22 trading days. Does it feel like doom and gloom? I'm sorry, but those are the stats and those are the factors that do affect the stock market. But hang on, I've got some optimistic stats as well to think about. Historical data does suggest a trend of generally positive performance for the S&P index, the S&P 500 index, during presidential election years. Out of the 24 election years since the inception of the S&P 500, 20 have ended with gains. On average, the total returns of the S&P 500 during the presidential election years from 1928 up to 2020, the 2020 election, have recorded an impressive average of 11.58%. So these are some interesting facts, but really your biggest concern is your retirement. Clint did a great job in today's episode of showing you how you can take control. Whether it's the election, some housing, a pandemic, what you can do to make sure that your portfolio is ready for volatility when it does hit. He met with a couple and he looked at where their portfolio was. He helped them make adjustments that make them more ready for volatility. He explains all this in detail in the show. I really recommend that you go watch that. One other thing I've heard the retirement planners here at Merkle Retirement Planning talk about is March of 2020. They saw all of this play out for the families and individuals that we serve. And here's what I know about 2020, that none of the families and individuals that we work with had to come out of retirement. None of the families and individuals that we work with called us in a panic when the Dow, or the S&P rather, dropped 30% in the weeks following the March of 2020 COVID outbreak. And none of the families were overly concerned about their retirement. Of course, they were concerned about the things that were happening in our country, concerned about the stock market, but not concerned that maybe they'd have to go back to work. So why? Why were they not calling in a panic? 2 reasons. This is what I've heard from the retirement planners. Here's what I learned talking to Lauren and the other retirement planners here. They were not worried because first we were calling them. We, as in the retirement planners here at Merkle Retirement Planning, we were calling them up and saying, yep, we know what's going on with the stock market. Remember, we talked about this when we put your retirement plan together. This is actually when we're going to take some action steps. We're going to take advantage of the stock market downturn. This is when we're going to employ some of those strategies we talked about before this volatility hit. That's one of the reasons people didn't have to come out of retirement. The other is they had a plan. Of course, those coincide, those work together. They had a plan with volatility in mind. They had a plan that knew that presidential elections will come every 4 years, a plan that knew that recessions happen on average every 5 to 6 years. So taking control of what you can control. We know that we can't control who's going to be in power, which party is going to be in power. Quite frankly, we can't control what happens with the stock market. You've got your retirement savings, the stuff that you've worked so hard to build, and that's really what you want to control. So the plans that the retirement planners here help people together, they are put together with volatility in mind. So if you turn on the news, if you go to your computer and go to your favorite news site, if you see a headline that says something about the Dow Jones dropping, the S&P 500 dropping, you're not worried that your retirement portfolio is experiencing that same drop. You know that you've planned with this kind of volatility in mind. And the retirement planners tell me that when they tell people this, that the looks on their faces are of confidence as they head into retirement, of relief that they're not going to be impacted by all these other factors, that they can retire, that they can stay retired, and that they can live the retirement that they are dreaming of. So you might want to know, how does this all work? Well, there's a lot that goes into it. It is a lot about investments, but there's a lot more pieces to the puzzle to help people invest with volatility in mind. Taking action, that's the thing that Clint talked about today. He's take action. You can't just sit back and see how your portfolio reacts. You don't want to go through a 2020 and then see what happens. You want to get ahead of it, right? So one way to take action right now for you would be to sign up for the online Journey to Retirement workshop. That's a way you can take control by learning, by empowering yourself, by educating yourself about what's coming, the decisions that are coming. You'll meet John and Sue. They're the stars of our online Journey to Retirement workshop. They're not real people, but what they are, they could be a lot like you. They want to retire. They want to retire and they want to maximize all of their resources. They want to make the best Social Security election for them. They want to invest with volatility in mind, and they want to save money on taxes. See how they do it in our online Journey to Retirement workshop. Go to retirewithmerkle.com and sign up for a time and a date that works for you.